Chapter 20 covers capital investment decisions. These are among the most important decisions made by executive management, since they're large dollar amounts and long periods of time and may indicate a strategic shift. Topic 1 is types of capital investment projects, and there are several types. Second is what is the process by which capital projects are brought to light, evaluated, and then finally decided upon. Third are what are the standard metrics that we use for evaluation of projects. Fourth is let's apply those metrics to projects and use them to say yes or no to projects. Fifth is let's look at two different types of examples. One is a fairly low risk project, which is an equipment enhancement of the factory. And the second is a new product development, which has more risk because it's a new product. And finally, we'll look at the need to continue to monitor, review, and provide feedback once the project is done. The comic on the right shows, my job is to make decision. Your job is to make them good decisions. You can't really deflect all of it to your people. Anyway, this is what we're in. We're in these life or death scary decisions. What are the types of capital investments? Well, first, there could be the middle one, which are fixed asset purchases. Normally, when we think of capital investments, we think of things that are very visible, like buildings and equipment, like we see here, a robotics line. Or they could be new products, like we're launching that robot, that robotic puppy. So new product development is a type of project that meet the criteria of spending time and also large in dollar investment. The third type is research and development, very common in certain industries, of course. We're looking at pharmaceutical example here with drug discovery. On the bottom left, we see market entry or expansions. Once we have success in a market, it's natural to then create a new beachhead in a new market to try to replicate that success elsewhere. And on the bottom right, we see acquisitions. M&A transactions are essentially very large projects. Instead of adding a robotics line, we're now buying an entire company. So these obviously have very big implications for both time and strategic direction. The capital investment process normally follows roughly this progression. It varies by company, again, because of the magnitude of these investments. The first step is idea generation. That would then lead to capital budgeting requests, and ultimately it's part of normal operations. So that's why it's linking both the capital budget and the operating plan. The cross-functional team brings it together to look at the full extent of this project to give it more credibility and more organizational support. The project proposal then is presented, and then it includes certain characteristics such as the business justification. That could be strategic or operational. Then the financial projections. What is the cash flow required to launch, and what kind of benefits might we expect from a successful running of this particular project? Third is the economic evaluation, using tools to evaluate one project and their profitability compared to another. What are the alternatives? Are there other things we could do to work this into existing operations or other partnerships that would reduce the amount of investment necessary? And finally, what's the implementation plan? The people, the timing, the processes that are involved to make sure this goes off and realizes the positive impact that we hope to see. The review process then brings that all together and evaluates how good is the business case for this investment. Then test the projections. Projections are assumptions, and we talked about models. So perhaps we would test some of those to see if they make sense in the test of reality and perhaps some historical data. The economic justification will also be looked at very carefully because this is the crux of how we choose between one and the other. Then we'll do a sensitivity analysis, which tests individual assumptions and see how vulnerable the project is on certain key aspects of the assumptions. Next, we'll look at the financing method. If we don't have the cash available, how would we pay for this? Is it debt? Is it equity? Or some combination thereof? And finally, what is the overall impact? Impact on the business, and in some cases, impact in the larger objectives of the company, like corporate social responsibility. When we're done with all that, some projects will be approved. It may involve the management alone, it may rise to the board, and in certain cases, it rises to a shareholder vote. An example of one rising all the way to shareholders would be the approval of a merger and acquisition. This is often proposed and recommended by the board, but the board cannot decide this without shareholder votes. So this is the common process for major acquisition. Once we get it approved, then we move into implementation. And as we've seen in other processes, we implement and then we monitor and then The capital investment proposal has many reasons for it to be done in a very thoughtful manner. First, it's high dollar amount. Some of these are equivalent of you bet your company. There might be limited resources, not just money, but they could be people or physical resources. And the trade-offs may not always be financial. There may be strategic goals that may overcome the more attractive financial benefits from an operational project. Some of the research may be to do incremental changes like extend the product or be more radical like new products or brand new markets. And finally, we might be able to strengthen key relationships with suppliers, customers, and partners. All of these proposals have assumptions in the future, but we have to be aware of the bias and different probabilities of outcome. It's very hard to sort out these projects because they're really tentative because they're based on future projections, all of them. The contents of the investment proposal would have strategic considerations, operational considerations, detailed financial projections, then other resources necessary, again, such as IT, the key management personnel, and other external parties which may be necessary for success. Then again, risk assessment to see what else may occur, and contingencies if those risks in fact occur. The third topic is time value of money. The concept is very simple. A dollar today is more valuable than a dollar 10 years from now. We could show that by way of an illustration. Here we just do a very simple scenario. You have $100. The interest rate is 10%. Let's let it sit in a bank for 10 years and see what happens to your $100. On the top row here, we see beginning balance. Then we show how much interest you earn for the year. And then we just keep it going for 10 years. At time zero, we started it, put $100. That $100 will earn $10 in the first year. But from there, the good stuff happens. That 110 is the balance after year one. At that point, it is the beginning balance for year two. That compounding, essentially paying interest on interest, leads to the ramp up of the interest payments. So it's not 10% of 100, which means 10% a year for 10 years. Notice how it goes from 10 to 11 to 12, eventually up to 17, 19, 21, 23. So this compounding effect is a powerful motivator for us to do investments because compounding feeds upon itself. This illustrates the basic notion of money being worth more now than 10 years from now. Because if we had a choice of having $100 now, let me take that $100, put it in the bank, and in 10 years, that will grow to $259. Or I could wait, get nothing for 10 years, and then you give me $100. What would you prefer? At the end of year 10 to get $259, or at the end of year 10 to get $100? I think we know the answer, $259. Now, this is a basic concept that is intuitive, and now we have a little clue on the math that makes it work. We can then simplify that to have some very important formulas that we use throughout this type of time value of money calculation. Here's the formula. The future value, time 1, let's say, is equal to the present value times 1 plus the interest rate. Now, if we go beyond year 1, it compounds, and that is a power function. That's why we see this caret, which means raised to the power of t. And this last part of the expression takes care of that compounding as we go from year 1 to 2 out to year 10. We can then rearrange the terms. You remember your algebra? Let's simplify the equation and solve for PV instead of FV. So we flip around the terms, and what we result on is a very important formula, especially for project evaluation, which is the present value of a dollar formula. And that's right here. The present value of a dollar equals the future value divided by 1 plus the rate of interest raised to the power of t. That is the factor we're going to use to bring back all the future cash flows back to today's dollars, so there's no time value of money distortion in our numbers. So what are the criteria? We know the basic math of time value of money. What are the criteria? There are 4 we're going to use in this particular chapter. The first is net present value. This is the most popular one used by finance professionals. It basically states that we're going to compare all the cash flows, not as they come in the future, but after they are discounted back to today's dollars. We call that time zero. So a dollar spent today is already at time zero. It's today. But a year from now, we're going to discount it back from a year from now dollars back to today. We do these systematically for each cash flow, bring them all to today's dollars. Now, There is no time value of money distortion. We can then add all those up. And if in general we get more money than we give, then we make money. That's a good thing. So that's how the idea works. Let's look at how the spreadsheet might make that happen. By the way, all these spreadsheets are in Excel, so you can see the actual math. I'll explain it to you since it's fairly straightforward. Here, the net present value has some requirements. We need to know the discount rate. Here it's given as 10. We need to spread the years. We always start with T0, which is today, because we have to kick off the investment with a certain dollar amount. From then on, it's year 2, 3 away from today. Then we'll lay out the cash inflows. Now, there may be a schedule that gives rise to this. We'll look at that in a moment. But here, let's use the net result of that analysis. What are the cash flows? Then we have a factor. This is that factor of PV equals future value divided by 1 plus the rate to the power of the time. And so these factors are 1, 0.9, 0.8. What this signifies is the further away you are, the less valuable that money. The closer you are, the more valuable it is, starting with 1. Today's dollar is worth $1. So we use that factor to multiply. If $1, let's take year 2. If $1 2 years from now is worth 83 cents, then $7,000 is worth 5,785. So that's how we use this factor, just to multiply the factor times the dollar amount for that cash flow, and the result, the product, is the present value of that cash flow. Now we have this string of numbers, which are the present values of each of the cash flows from the initial all the way out to year 5. And the net present value is you sum them and you get 5,607. First of all, it's positive. Positive means that despite the discounting back, notice that we reduced these numbers because of the discounting. Despite us making the numbers lower, it's still higher than the initial investments. So that's a good investment, meeting the criteria that we want, that it meets or exceeds the required rate of return, in this case, 10%. So first is the science. Secondly, the more the magnitude of the dollars, the better it is. If you can invest and get 10 million NPV dollars, that means this project is quite valuable. If the NPV equals 1, like $1, it still meets the requirement because we've already discounted the money and we've already essentially earned the value based on the discounting itself. If it earns $1 NPV, that means it's still above our minimum requirement. Let's go all the way to the extreme. What if it's 0? If it's 0, that means the cash flow generates exactly the rate of return you set as your minimum. So it meets exactly your minimum. So is it exciting? Maybe not too exciting, but does it meet your criteria? Yes, it meets your criteria. So, simply stated, NPV to be acceptable must be greater than or equal to 0. And the higher it is, the better it is. That's it. All right, so that's the NPV. Second, we'll look at internal rate of return, abbreviated as IRR. This is preferred by many people because it's very intuitive. And for example, if I were to do an NPV analysis, I would say something like, I've done an analysis of the cash flow from this project. The net present value based on a discount rate of 10% is a positive $6,000. Therefore, we should do this project. That seems pretty long-winded. And if you don't know finance, that sounds a little bit confusing. So let me try out IRR. We've done an analysis of the cash flow that we expect from this project. This project will generate 18% internal rate of return. We need 10%. So since 18% is quite a bit more than 10%, this is a good project and we should fund it. Now you see the allure and the usefulness of IRR. It's just intuitive. Most people know that a higher percent yield is better than a lower percent yield, and that's what IRR is all about. The calculation is quite simple. Again, this is in Excel, but this one's super easy. We take this particular stream and we put the function equals IRR and shade that region starting at time 0, and we get 18%. Next is we're looking at profitability index. This is a slight variation of net present value where we don't do the subtraction to get plus or minus. Here we take the numerator to equal the present value of all the future cash flows, and the denominator is our initial outlay. One way to interpret this is, for every dollar of outlay today, how much money will we get? Therefore, if we get more than $1, we like it. So this is very simple. If 1 is the numerator and 1 is the denominator, that means 1. 1 is where they're equal. What we seek to do is more than just equal. We want to have more return. So the decision rule is if the profitability index is equal to or greater than 1, it's a good project meeting our criteria. And the more positive it is, the bigger the numerator is, the better the project. Very similar to NPV. The higher the dollar amount, the better. Here, the higher the index, the better. Oh, by the way, here, the same cash flow yields a 1.23 over 1 favorable project. The next method we'll look at is called the payback method. This one does not use time value of money. It uses just the money. The simple question we're answering is, how long does it take to get back your money? That's it. No time value of money, no percentages. You put out a certain amount of money. How long does it take for you to get it back? So let's look at the cash flows. It's the same cash flows that we use for NPV, IR, and PI, and it has this strip right here. The next row is important for determining payback. We're taking the cumulative. So at time 0, we're out $24,000. Next year, we get 6, so we're net 18. The following year, we get another 7, so our net drops to 11. And notice what happens somewhere between years 3 and 4. Year 3, we're still in the negative. We need 3,000 more. But in year 4, we get 9. So what we do to compute the payback period is we go to last year when it's negative. That's the whole number. Then the fraction is how much extra you need and how much of next year we need to get to accomplish that amount. So here at the end of year 3, we're short $3,000. In year 4, we make 9. So we need 1/3 of year 4 to make up that extra 3 to get us exactly to 0. And that's the idea of payback. So this particular example, the payback period is 3.33 years, which is the time that it takes for us to get back our entire $24,000. Right? So that's payback method. It's pretty easy to understand, but there are some weaknesses in this method. So let's pull all those together. We have 4 methods, and we'll look at the pros, cons, and make some overall assessments. Net present value, it is a DCF method. In other words, it takes advantage of time value of money concepts. It's in dollars, so we know if we created value. If we have $1 million of NPV, it's $1 million of money we expect to get from this project. The cons are, it's hard to explain to non-finance people, as I illustrated a moment ago. It's a mouthful. And it also doesn't show capital efficiency. If I take $1 million to generate $1, it's okay. But what if I had another project that I can get in, generate $1, but it only takes $500,000? So we may be able to have a very favorable project and then use the extra cash to fund other projects. It doesn't deal with capital efficiency, which allows us to allocate the money across multiple projects. So overall, finance people like it, and it's good to pair with other things like IRR to explain to other people and PI to look at capital efficiency of the different projects. The second method was internal rate of return, IRR. The pros are it is DCF method, and secondly, it's easy to explain to finance people. This project earns 18%. We need 10. Therefore, it's a good deal. Well, that's it. Pretty much that's it. The cons are there's a technical flaw I don't want to go through now. It's about the reinvestment of the cash flows that occurred during the holding period. There's an assumption that every single cash flow in the IRR yields that exact same percent. And that creates a little hole, a little bit of a technical flaw. The other thing is it could be a high percent, but so what? What do you mean, so what? What if I need 10% and it generates 30% IRR? Well, what if it is a project that takes $100? Is it possible that a $100 investment will yield a very high IRR of, say, 30%? Yes, it is. Well, how much money did we make? Not a lot, because we only put in 100. So one of the cons of IRR is it does not consider the magnitude of the investment. Overall, it's good to use to explain to people, but it's really not what I would use for decision making. So I would use NPV tools for decisions, and then when I explain it to non-financial people, I'll bring out the IRR. They generally come up with the same answer anyway, so there's not really a difference in decisions in terms of yes or no on projects. It's just how do we explain it so people can understand. The third measure is profitability index. As you recall, the numerator is the future cash flows brought back to present value. The denominator is today's cash outlay. So if the number is greater than 1, The cash inflows are greater than the cash outflow. Therefore, we want it to be greater than 1. The more above 1, the better. So it's a DCF method. It's easy to explain that for every dollar of investment, we get $1.23 in return. Oh, I'd rather have $1.23 than $1. So it has a bit of that allure that IRR had, easy to understand. The cons are it doesn't capture the magnitude. It just gives a ratio. Again, what if we invested $100? So what? I don't care what my rate of return is. It's probably not worth doing. Stated a different way, it could show a high PI, but with low dollars, it doesn't matter. Overall, it's a good thing to look at for capital efficiency. The last is payback period. The pro, it's easy to explain. It takes me 3.3 years to get back my money. The cons are it's not DCF, so it ignores the time value of money, which is silly. Money is not free, so that's a pretty big assumption to not consider. And furthermore, it doesn't look at the cash flows beyond the payback period. Let's consider a situation. It takes 3 years and a third, in other words, 3 years and 4 months to get back our money, and then the project dies. Well, yeah, the payback period is 3.3, but thereafter there's no more asset. It goes away. So that becomes a bad investment. Or conversely, is 3.3 years, and this project will go for 50 years. Wow, that's a great investment. So those two both have the identical payback period, 3.3. One is a dud because it dies right after it reaches 3.3. The other goes on for a long, long time. So the method of payback period does not really capture the difference in those two scenarios. Those are extremes, admittedly, but it does highlight the weakness in the payback method. So overall, it's a good first cut. It's easy to do. And if it's a high payback, let's check out with more thorough analysis if it indeed is a good idea. Section 4 is an evaluation of the economics of the investment. So we're going to use these tools on the projects and see how it shakes out, which is the rank order of projects in terms of economic attractiveness. The first thing we always need is the cash flow. You notice that's where we started with in the DCF methods of NPV, IRR, and PI. Here's where we have to project the components that get us to that number. It could be capital outlay, there could be revenues, there could be operating expenses, there are income taxes, there's depreciation. So we have to go through all the future cash flows that are relevant. Relevant means that's in the future and that it differs. If there's something you're committed to pay anyway, it's no longer a relevant cost because you're stuck with it. So relevant, again, is future and it differs. Some people use a simpler word to just describe this as incremental, which means it's extra, right? That's what increment is. So incremental kind of gives this notion of it's extra, something happening in the future. The other definition of cost you may hear is sunk costs. A sunk cost is something you spent in the past. Hate to say this, but you can't do anything about it. So a sunk cost is sunk, which means it has no bearing on your future cash flow projection. It's hard to ignore it, but that's analytically what we would have to do. Also, we need to consider opportunity costs. If you had this factory to build snow globes, and yet it could be meant to develop robots, I think it's a better use to develop robots. You can go through an entire analysis showing how this factory can earn some profit making snow globes, when in fact the other choice, the opportunity cost, is massive because you could deploy that factory to manufacture very valuable robots. So this is the idea of an opportunity cost, and these need to be considered when we're making decisions. The details of this would be capture all cash flows, everything in, everything out. And then also specify the timing because time value money are going to be employed. So is it T1, T2, T3, etc.? Those matter because the time value money is brutal, making long-term cash worth a lot less than shorter-term cash. The second group are let's make the decision. So we're going to use the tools of DCF, namely NPV, IRR, and PI. We're going to look at payback, and then now we're going to consider everything, the financial and non-financial sides. The last point is accept, reject, and deferred. If we're basing it solely on decision metrics, we know the rules are simple. NPV greater than or equal to 0 are acceptable. IRR greater than or equal to the minimum return rate is acceptable. Payback, well, there's no metric for it. It's a gut feel that senior management say, I want my money back in 4 years. Oh, it's 3.3? You've met my requirement. but it's not really a quantifiable finance metric like we have in NPV and IRR. So why decisions aren't just math? It's because there are other goals. There are economics that we're going to do, like NPV, IRR, etc. Then there's strategic, where we have short-term and long-term objectives. Then we have customers. Can we strengthen a customer relationship, which is even more valuable, perhaps, than a little bit of extra profit? Then there's safe. If there's a factory with a safety issue, that overrides other investments you might make. We don't want to jeopardize the safety of our own employees. Then organizationally, there may be limitations. We may not have IT staff necessary to support the project, or management is busy, they can't afford to watch over this project either. So there are some organizational considerations that sometimes are constraints, and we have to consider those. There are certain common pitfalls we see in cash flows. The first is optimism versus realism. We've seen this throughout our discussion of projections. We need to be objective so that we can base decisions on it. If we come up with overly optimistic and it gets funded and reality doesn't match our projects, there might be trouble. Furthermore, we know that business conditions change over time. If we're the first to market, we know that over some time period, we're going to attract competition, which will erode our profitability because prices will go down. Perhaps the high sales growth will slow down as consumers have more choice. The second is there may be below the line cash items. These are tricky where we say, okay, what's the income statement implications? But there's more than just income statement. We sometimes have to buy inventory to start things off. Or we might sell, but we sell on credit, so we have to carry the receivables. So these are other considerations we need that relate to working capital. If we buy a depreciable asset, we're going to depreciate that over time. Now that's a non-cash charge, so why do we bother? The reason we bother is that we can depreciate, charge an expense, and save taxes. And saving taxes is a cash item. So that's why we look at depreciation, not because of depreciation per se, because we're going to subtract it, determine tax, and we're going to add it right back again because it's a non-cash item. And finally, remember that at the very end of the project, we sell all our assets. We collect our receivables, we sell all our inventory, and whatever we paid to kind of build the mass we need to be in the business, at the very end, we sweep it back off the table because it's our money. Then when we look at Excel, there's a little magic where everything seems to grow. It seems to be built in to have rose-colored glasses. So be careful to monitor whether these assumptions are just running away or if they're well thought through. We could see that margins might erode over time. We could see units may hit a peak and then go into maturity and decline. So there are many factors that could affect the future, and don't just hit an Excel command and make everything grow to infinity. It doesn't work that way. Here are a couple of examples. The first is a manufacturing enhancement where we can invest in some equipment to lower our costs. There's a high initial capital expenditure, in this case $150,000, and there's a steady improvement in costs because we're lowering our cost of operations. Next, you'll notice that there's a lower discount rate. It's 10%. Why? Because in senior management view, this is just what we do. It's not a high-risk venture. So therefore, if it's not a high risk, we don't need to have a high hurdle. The NPV bears that out. This project generates over $29,000 of positive NPV, which checks the box as being acceptable. Next, the IRR is 13.24. If our hurdle rate is 10, once again, checks the box. 13 is greater than 10. The PI is over 1. It's 1.16. Checks that box. More inflows than outflows. And finally, payback period, 4.79 years. That's, again, neither here nor there. I kind of want to get my money back faster, but that's not too bad. So now I will hop into Excel just so you can see the format a little more clearly. So this is Vance Pharmaceutical, and they've developed this idea to lower the cost of manufacturing by investing in some equipment. Pretty typical for a manufacturing company. So going through this, we have years going from left to right, and then we have revenues. Notice 0. Why is that? Because it's a cost reduction project. We're not going to generate more revenue. We're just going to be able to manufacture at a lower cost. And that's where we capture this row. This row represents the savings in manufacturing if we employ this new piece of equipment. That is the net impact, net profit impact, a positive one because we lowered our costs. Then here's what I was mentioning. Furthermore, there may be depreciation. non-cash charge, but we do need that to get to taxable income. And in this example, there were some expenditures we would make in the very first year that are expense. They're not capital. Could be salaries, things of that sort. So this row here represents the amount of incremental operating expenses, and this is operating profit line. This is taxable. In the first 2 years, you'll notice that the tax expense is a positive number, which offsets the cash flow. So we have a negative cash flow from running the business, but we get tax benefits. So we get offset some money we made elsewhere and not pay taxes on those. And here's the benefit we get from that. Then thereafter, we could see that we're paying taxes because we're starting to make money. This is the row, which is the operating profit after tax. That's an accrual basis number. To that, we have to add back depreciation, which is a non-cash charge. Notice what happened here. We had this idea where we had depreciation we add back, but we subtracted depreciation here. That's what I was referring to. We subtracted here, we add it back there. What's the difference? The difference is right here. In those years where we had some item, there was a tax effect. It served to lower taxes. That's why we go through this dance. Next, we'll look at changes in working capital. As we build a business, we have to feed more inventory, we have to carry receivables. The one thing that people often forget is at the end of a project, we get to collect all that money back. So whatever we put out there in the way of inventory or in receivables, we collect it all at the end of the project. The cash expenditure of 150 is the initial expenditure. This blue line then represents our net cash flow. So in that earlier example, all we had was one line. It's this line. It's the net cash flow for each time period. And to that, we could do our math, our finance math. The first piece of finance math is the present value. So here's the factor that shows it at the discount rate of 10. Again, the formula is as follows. 1 divided by 1 plus the interest rate of 10% raised to the power of time. Now, you look at this expression, it looks a little tricky. Like, why does that look like that? It's because we started with a base year of 2018. And in the year 2018, that's time 0. So we need to take time of 2018, subtract 2018, we end up with 0, and we have factor 1. It's easier to think of in terms of 2019, 2020. Let's say 2020. 2020 minus 2018 is 2. Oh, that's right. That's the second year out. So that's why this formula works when you have the calendar year as the header in the row. So now we can then do the math here, which is the factor that we just derived times the cash flow. The resultant product is the present value of those cash flows. When we sum those all together, guess what? Net present value. Here, the net present value is 29,132. The IRR, a very simple formula, is we say IRR, then open parens, shade the entire region, starting with time 0, close parens, enter. In this case, that's how I got 13.24. The profitability index, again, is future cash flows, present value, divided by current cash flow. So if you double click here, you'll see it's the sum of the future cash flows from time 1 out to the end, divided by the initial cash flow here. And I put a negative sign, so it ends up with a positive number. So the result is 1.16, which is greater than 1, which makes it acceptable. Now I want to show you a trick that is a little dangerous, so pay attention. I could just off to the side here put equals NPV. Now you would think that I need to put in the rate, and the rate is 10%, comma, and you would put in the entire range that we see here in the blue, starting with negative 150 or 180 all the way out to here. That would be an error because if you look closely at this parameter, it's called value 1. That's a clue that we start with year 1. So the proper way to do the NPV calculation in Excel is to shade not time 0, but shade time 1, all the way to the end. Close parens. Now if we hit enter, let's just hit enter. That's the present value of all the money we're going to get. Now, let's say, what's the present value of our cash outflow? Namely, times 0. That's 180. And you take this number, the big number, and then you subtract it from 180. You get 29,131, which is the same as this number. So whether you do it the old-fashioned way with the factor, or you do it the Excel way with the NPV function, you will get exactly the same number. There's some advantages to going through it the old-fashioned way because we could visualize the cash flow as it occurs, which you don't necessarily see or focus on if you just do a whole range in Excel. And the other reason is we want to be very careful that we do the formula correctly. All right, so let's say Vance Pharmaceutical had another project. This project is a new drug that they're hoping to get approved and out to the market. It cures procrastination. Oh, sounds like a high potential product. So here we have the formulas similar. It looks very similar to the equipment example, but there are some very important differences. So I'll point those out when we go to Excel. But just at a very high level, there's a fairly low expenditure necessary. It's $50 million. There's a slow ramp up in the revenues because it has to go through drug approval. Because it's higher risk, there's a higher hurdle rate. So rather than being 10, like the first example with the equipment, it's 15%. Furthermore, we notice that at the end of the time period, it's still going. Therefore, we need a terminal value. The terminal value represents how much can we sell that business for at the end of the investment horizon, in this case, 2025. So if we were to sell this very strong product at the end of 2025, how much money would somebody pay us for that product? And we'll look at that in the Excel formula. Just to take a peek at the bottom line, NPV is very positive, $413 million. The IRR is very positive, triple our required 15, and it's 50, not 15. And then the index of profitability is 7.6, so we're 7 times our initial investment. The payback is still pretty slow because we're waiting to get back our money. That's why of the metrics, this one shows a slow payback, but otherwise it's looking like quite a winner. Let's go to Excel. If we go to Excel, what we'll see is the spreadsheet, which again looks very similar to the manufacturing one for the equipment, but let's point out the differences. First, we have revenue, albeit slow ramp, we're getting revenue. Next, we have some cost of goods sold, and we have a gross profit right here. But since it's an ongoing business, we're going to have some expenses to pay against that cost of goods sold. We have depreciation, which is an expense that we can charge for the purpose of lowering taxes. That gets us to an operating profit, pre-tax. Then we pay tax, and we end up with after-tax. So this is an important number. It's the after-tax operating profit. But we're not done yet because these are the adjustments I warned you about. Here are adjustments to add back depreciation. We subtracted it here as an expense just to lower our taxes. And here we add it back because it's not a cash charge anyway. This is the series of working capital that I described earlier also. Working capital are increases to cover the receivables and the inventory. So we add to it along the period because as we have more and more sales, we need more and more inventory and we have to carry more and more receivables. But at the end, we collect it all. So our assumption in these models is at the last year, we collect back all our receivables and then we get rid of our inventory. So that's how this works. We get to this row, which is the operating cash flow that is incremental, excluding the terminal value. This green item on the right is the terminal value. I'm going to make this a little larger. And so the terminal value has this formula. We take the cash flow from the outside year, the horizon ending year. In this case, $145 million. We grow it one more year. So it's 1 plus the growth rate. Here the growth rate is 0, but proper form would have it be 1 plus the growth rate for the next year. We take that as a numerator and divide it by the discount rate, in this case 15%, minus the long run growth rate, which is 0. The result of all that is $971 million. Now, we're getting that at the beginning of 2026. So we ended 2025, we're selling it on the very next day, the first day of 2026, which sure sounds more like the last day of 2025. So therefore, from a present value standpoint, we do this adjustment here. Here are all the cash flows, which are easy all the way to the last year. So let's focus on this cell. This cell is the last cash flow for 2025. You add to it the value of the terminal value. and that is the 971. So we get this big number at the very end, 1,116,000. Then we can do all our factors of present value. Same thing, 1 divided by 1 plus the rate raised to the power of time. And then we get the PV of the cash flows right here. The NPV is a sum of those cash flows. It leads to a total value of 413,000. And then the IRR is easy. We shade the entire region, not just T1, but starting in T0, and we get 50%. The PI, profitability index, is the sum of the present value of all the cash inflows divided by the initial cash outlay. And we get to 7.6. And here is the proper way. I'll just do it from scratch so you can see the keystrokes. Equals NPV. This is if we don't do the factor method. The rate is 15%, comma. The cash flows, here, be very careful. Start with T1, not 0. So here are the cash flows. Close friends. That number represents the present value of all the positive cash flows. From that, we have to subtract the initial outlay of 62. And when we add those two together, we get 413. Oh, that number sounds familiar. This number, 413, 135, is exactly the same as this number. So the two methods of computing NPV give you exactly the same results. This number was derived by doing it the old-fashioned way with a PV factor. This method was using the shortcut of the Excel function for NPV. Both work. I'm not telling you which one's better because there isn't one better. Once we're done with the project, it's not over. We still have to do things like making sure it generates the kind of cash flow that we're expecting it to do. So we finish it, we approve it, and that's a big day. But once the approval takes place, the work, in a sense, just begins. We monitor to make sure the actuals come through like we expected. Then we will compare it to what we expected, and we close the loop. So we look at how we did compared to what we forecasted. And that's to give us integrity in the process, so we're not getting projections on one basis in non-reality, then reality strikes. We don't want that to happen, or at least not unnoticed. Here we're going to close the loop, so we look at what did we project, what did we get, and what's that difference. That will give us an opportunity to recognize high accomplishment, or on the other side, to identify and address shortcomings, and also inform future decisions. So we're closing the loop just like we've seen. We're going to close the loop on every projection that we do for the company. So chapter 20, wrapping up, we see the different kinds of capital expenditures is really not a hard asset kind of capital expenditure. It means a lot of money that will span a number of years in terms of investment horizon. Then we looked at the investment process, the steps that are taken to be careful in selecting the right projects for the company. Third, there are some time value money metrics. So we just reviewed those. You've probably seen them before. Those are PV of individual cash flows, net present value, IR, and PI. Then there's a non-DCF method of payback. Then we apply those to look at different decisions and how do we use those in decisions and how do we sometimes have to temper those with other considerations. Fourth, we looked at two examples of projects. One is a pretty simple one. It's extending the productivity and life of a factory by adding to the capital equipment. The second is a more ambitious one, is launching a new line of business, which has many years to go. Those two have different, slightly different math because of the circumstances. Then finally, we recognize that once we approve the project, it's not over. We still have to make sure it happens effectively. We monitor, we track, then we circle back and close the loop on what did we expect, what did we get, what did we learn? And that leads to the type of management that we would like to have, where we do the entire cycle for every project and every projection we undertake. Thank you.